So we're going to have a look at what an ETF is. So let me just write that down. What is an ETF? Well, an ETF is, it stands for Exchange Traded Fund. And what that means is that it is a fund, a collective fund, like an investment trust or a unit trust, but it is traded on the stock market, so you can buy it and sell it just like you would an ordinary share. What are the advantages of it? Well, the main advantage, there are two main advantages. The main advantage of an ETF is that its cost is lower than the cost of a unit trust, say. So you're buying a fund that has low management fees because it isn't really managed in the same way that an actively managed unit trust or investment fund is managed. What is done is that it is set up to mimic a certain group of shares or a certain sector or a certain group of commodities, and then it is just allowed to run and follow that market. So there is no discretion on the side of the manager. The manager is simply following an index or a sector. And we'll come back to that in a second. And the other advantage is that it gives you access to lots of different markets. A bit like spread betting, which we talked about in another video. If you want to invest in gold, for example, you have the option of buying physical gold. But there are costs involved with that are quite high. So if you're a small investor, if you're a private investor, then the cost of entering the market through an ETF is really quite low. So you might want to invest in gold, you might want to invest in other metals, you might want to invest in a sector like the biotechnology sector. You might want to invest in oil or any number of slightly unusual investments can be made through an ETF. So for a private investor, it's a pretty good thing. The management of it is down to you. So you're making your own investment decisions, and of course you can lose money as well as make money by doing so. But once you know where you want to invest, an exchange-traded fund gives you access to that market for quite a low price, and it trades like a stock. So there is price transparency, which there isn't always in something like a unit trust. At a unit trust, often only the price is only quoted once a day, whereas with an ETF, the price is quoted all the time, just like a stock. You can also get short funds as well. So perhaps you want to go short on a market. You can do that through an ETF. If you want to go long in a leveraged way on a market, you can do that as well. There are ETF funds that will give you exposure to 2 or 3 times the leverage that you would get through them buying the asset. So there are S&P funds that will be leveraged so that for every point that the S&P 500 goes up, your fund goes up by 2 points, and likewise for every point that it falls, it goes down by 2 points. So if you have limited funds, if you're not a massive investor, rather than buying individual stocks, you can buy into sectors and groups of stocks in a very cost-effective way, and that is. In short, that is what an ETF is. By all means, if you have any questions about ETFs, then put them in the comments, and I will try to answer those for you. I can't give financial advice, but if you have questions about what an ETF is and how it works and that kind of thing, then please let me know. I'd be happy to answer that. And of course, bear in mind that investments can go down as well as up, so always be careful when you're investing. And we will be back in another video.